In this week's video, we'll review the rational case for stock market plunges in 1987, 2011, and 2017. To view the video in full screen mode, use this icon in the lower right-hand corner of your video player. To improve the clarity of the charts, use this icon in the lower right-hand corner of your video player. Since we're trying to take a rational look at the 1987 charts, 2011 charts, and 2017 charts, let's link back to a topic we covered on September 8th, 2017, where we compared hurricane forecasting to probabilistic forecasting used in the financial markets. Clients and regular viewers may remember the National Hurricane Center was waving yellow flags 11 days before the major hurricane hit Houston earlier this year. And 10 days before that major hurricane made landfall, they were talking about and citing 3 disturbances in the Atlantic Ocean that they were concerned about. And as they continued to put hard data into their mathematical models and reviewed the output 8 days before the major hurricane made landfall in Houston, they were now reporting there was a high chance that a tropical cyclone would develop. Given there's always a small percentage of market participants that are worried 24/7 about crashes and corrections, let's tie this analogy of using facts instead of fear to look at probabilities. This portion of the video is being recorded on Thursday evening, October 19th. In the present day, based on the facts that we have in hand right now, what are the odds of a major hurricane hitting the eastern half of the United States in the next 5 days? And we know in order to answer that question, we want to look at hard data or a set of facts and then run them through our mathematical models based on logic. Thus, given the data that was available on Thursday, October 19th, what are the odds of that storm forming and hitting the United States in the next 5 days? If we look at the hard data that was available from the National Hurricane Center at 2 p.m. Eastern Time, lower left-hand corner of your screen, on Thursday, October 19th, based on the hard data that they have in hand and their mathematical models, they're basically saying there's almost a 0 chance of a new tropical cyclone developing over the next 5 days. Therefore, if there's basically a 0% chance, and it's never 0, but it's a very, very low probability that a new tropical cyclone would form in the next 5 days, then we also know, based on the facts that we have in hand, as of Thursday, October 19th, there is a very low probability of a major hurricane hitting the eastern United States, or the eastern half of the United States, over the next 5 days. We can use the same principles of looking at hard data and running them through probabilistic models to answer this question on October 19th, 2017. What are the odds of a 1987-like stock market crash occurring in the next 5 days? And very, very similar to the forecasting models used to track hurricanes, in our case, we would collect the latest data that we have on the markets, we would put them into our mathematical model, and we would ask, based on the facts that we have in hand today, not what we're fearful of, what might happen, based on the facts, are we allocated properly? As the years have gone by, there's an increasing perception that stock market participants in 1987 left work on Friday, October 16th. They showed up at work on Black Monday, Monday, October 19th, 1987, and were totally caught off guard. This was a major black swan, came out of nowhere type event. If that perception is true, it tells us in the present day that we could leave on a Friday afternoon and everything's fine, and we could come to work on Monday morning and all hell could break loose. is there any factual basis in that theory or perception of what happened in 1987? The answer is absolutely, positively no. In fact, this is a weekly chart of the S&P 500. This is the S&P 500 here. This is weekly MACD. This is weekly RSI. Was everything just rosy the week before Black Monday? Not even close. There were a ton of yellow flags waving, including something as simple as the week before Black Monday. So the 5 trading sessions that preceded Black Monday, the S&P 500 dropped 9%, telling us that Black Monday was the furthest thing from a technical, out of left field black swan. What about price? The last weekly closing high was made over 2 months before Black Monday. This chart is dated Friday, October 16th. Black Monday is the following Monday, or Monday, October 19th. Price makes a discernible, we can see this, measure it, put it in a model, lower high relative to the high that was made in August of 1987. And we make a discernible weekly lower low before Black Monday. About intermediate term momentum as measured by MACD. We get a bearish yellow flag, bearish cross in MACD here over 1 month before Black Monday. And RSI has a very, very weak and waning look. RSI drops below 70 here, which is a yellow flag. Comes up here, looks very, very tepid and weak, and eventually crosses below and closes below 50 on the weekly chart. We can see all of this, measure it, and put it in a model before Monday, October 19th, 1987. And this 9% loss the week before Black Monday tells us no one should have been caught totally by surprise that something might possibly go wrong on the following Monday morning. If you know your market history, you also know there was a waterfall-like plunge over several days that took place in calendar year 2011. There were also several yellow, I can see it, measure it, and put it in a model, yellow flags waving before the real plunge began. After this point here, stocks fell sharply in this direction. This chart is a weekly chart dated July 28, 2011. Much like the 1987 chart, the weekly chart is making discernible lower highs. The last closing high on the weekly chart was made almost 3 months before the plunge that takes place here. We had a bearish moving average crossover that we could measure, see, and put in a model. This is a fact here. It occurred over 4 months before the plunge in 2011. And we also have a very tepid weekly RSI here, below 70, can't recapture 70 here, closes below 50 on a weekly basis, and then before the plunge closes below 50 again. Therefore, if you left work on October 16th, 1987, or you left work on July 28th, 2011, and over the next 1 to 5 trading days, a waterfall decline occurred, that shouldn't have been a major surprise. These are vulnerable looking markets here that are telling us we better pay closer attention. So the charts that we just reviewed, the 1987 chart and the 2011 chart, are similar to these periods here where the hard data is telling you that there's a higher probability of something going wrong. We can see this, measure it, and put it in a model 8 days before this major hurricane made landfall. And we also noted in the present day, October 2017, skies looked pretty good from a hurricane or tropical cyclone perspective, telling us there's a very, very low probability of something bad happening in this area here or here in terms of a major hurricane over the next 5 days. How does the October 2017 stock chart compare? Does it have a concerning look like this or a concerning look like this from a probability perspective? Or said another way, what are the odds of a 1987-like stock market crash occurring over the next 5 trading sessions? Based on the facts, we can see it, measure it, and put it in a model on October 19th, 2017, we would have to say that the probability is relatively low. The probability of something really bad happening is never zero. When we compare the present day, this is the same exact weekly chart of the S&P 500 with weekly MACD and weekly RSI. In the present day, we've been making new weekly closing highs. Before the disaster happened here, the last weekly closing high was made almost 2 months before. And in this case, before something really bad happened, the last weekly closing high was made 3 months before. Right now, on Thursday, October 19th, we're on track to make another new weekly closing high, and that's to be determined on Friday. Bearish MACD crossover well before bad things happen. Bearish MACD crossover well before, several weeks before Black Monday. In the present day, instead of having a bearish MACD crossover, we recently had a bullish cross where black went above red. We can see this, measure it, and put it in a model. We can also see that on October 19th, we're not close to getting a bearish cross here based on the data that we have in hand today. Does weekly RSI look vulnerable in the present day? Below 50? Below 50? Not even close. It's still above 70. You can make an argument that this is overbought, and that's negative. If you study charts, and we've talked about this before in past videos, weekly RSI above 70, as long as it stays above 70, is bullish, and good things can happen for a long period of time with a look like this. Concerns would start to increase when weekly RSI drops out from a probability perspective. We're not close to doing that on October 19th. RSI is at 74.33. So just as the hard data that the National Hurricane Center has in hand on Thursday, October 19th is telling them that the odds of a major hurricane hitting the eastern half of the United States over the next 5 days are very, very low. They're not zero, but they're low. The hard data, forget fear, forget about what may happen tomorrow. The hard data that we have in hand in mid-October 2017 is telling us that the odds of a 1987-like or even 2011-like stock market plunge occurring over the next 5 trading days, they're not zero, but they're very low. If you have not seen it and you want to watch the analogy between hurricane forecasting and probabilistic forecasting in the financial markets, you can Google this title here in the lower left-hand corner of your screen. You should be able to find that video on the Shivako Capital channel on YouTube. If you watch these videos regularly, you know the CCM market model is a well-diversified model. It uses multiple inputs on multiple time frames. In this case, we're looking at the 60, 70, 80, 90, 100, 110, and 120. These are simple, for illustrative purposes only, daily moving averages. This is the look the Friday before Black Monday. This is the look on July 28th, 2011, the same 2 periods we just looked at when we were looking at weekly RSI and weekly MACD. In both cases, we can see flattish looks to our moving averages, flat and tight. This is telling you to pay attention that a big move can come. And now we also have a bias where it looks like the slopes are starting to roll over and price was above all of the moving averages and now it's below. We can see this, measure it, put it in a model on Friday, October 16th, 1987, before we left the office. The situation here in 2011 is even more concerning because notice blue, the fastest moving average, has migrated from the top over here all the way down to the bottom. Why would we care about this, and how could it help us? Because when we had this data in hand, after we could see it, measure it, and put it in a model, the S&P 500 in this case lost an additional 21% before it bottomed on a closing basis on December 4th, 1987. And in this case, we lost an additional 15% from this point here down to here. We finally found a closing low. This started on July 28, 2011. We didn't find a low on a closing basis until October 3rd, 2011. We know from watching past videos this is a low probability look, and after this, bad things happened. This is a deteriorating probability look, and after it, bad things continued to happen. How do the exact same moving averages look today? As you might imagine, October 19th, 2017, the exact same moving averages, and the answer is much, much better. We talked about multiple time frames. How about a weekly moving averages? This is the simple 22-week moving average, October 16th, 1987, the Friday before Black Monday. This is the same July 28th, 2011. Notice the 22-week is flattening out and rolling over, and price has moved from above to below before Black Monday. Similar situation here, but it actually looks a little bit worse. This slope is more pronounced for a longer period of time. Price came down and tested it and passed, and then decided that it was going to fail. As you might imagine, the same chart on October 19, 2017 looks much, much better. The slope is down, price below. The slope is down, price below. The slope is up, price above. One of the great things about having a well-defined approach and process is you basically know in advance how you're going to handle situations. Remember, in past videos, we said that all market profiles, for the most part, fall into three categories. We either have bullish uptrends, sideways consolidation or indecisiveness, or bearish downtrends. And your well-defined process and approach can help you handle all three situations in a wide variety of circumstances. So if you're a client, a logical question may be, how would the market model handle something like the 1987 crash? And the answer is, it would handle it the way it would handle any situation. We would collect the latest data and set of facts, run it through the model, and continually ask the questions. Are we allocated properly based on the facts that we have in hand today when we're using the investment application? If the answer is yes, we leave it alone. If the answer is no, we make incremental adjustments. So to answer the question with a quick back of the envelope explanation, let's use the trend strength model, which is one of the models that feeds into the master market model, as a proxy for the entire model. This is the chart from 1987. Over here on the left side of the chart, the market peaks in August of 1987, and the trends are incredibly strong. At some point out on the left side of the chart, the trend strength model has a score of 100. When we get to the Friday before Black Monday, the trend strength model has dropped down to 73%. Therefore, as we go through our process from point A to point B here, as we continually ask the question, are we allocated properly based on the facts in hand, we're going to get some no's along the way, and we're going to make incremental adjustments between point A and point B to make sure when the market closes on Friday, October 16th, 1987, that we are back in line with the facts that we have in front of us today. It's also very, very important to acknowledge that some market profiles are harder than others, and there's no question that Black Monday is a very rare situation and a difficult situation. However, we would handle a 20% drop in the exact same manner that we would handle a rapid 6% drop, an 8% drop, a 10% drop, or a 30% drop. And part of building a system and a model is acknowledging in advance that you can have intraday dislocations or waterfall plunges. Our process doesn't change. We basically just use the flow chart intraday several times. So when the market opens on Black Monday, Monday, October 19th, 1987, we've already taken several incremental steps to reduce risk. When Black Monday arrives in the morning, when the market opens, we would update the model and see how much damage was done between Friday and the open on Monday. Basically run our exact same approach. We have to take incremental steps intraday to get in line with the weight of the evidence. Late in the day on Black Monday, we would have seen that the hard evidence had dropped from a 73% bullish response rate all the way down to a 45% bullish response rate. We would take incremental steps intraday. Why do we do it that way? If the market gaps down at the open and it's down 20%, but it's only 10:30 in the morning, we can't assume that the market's not going to rally. So you basically take incremental steps. If you're way out of line about an hour into trading, you would take an incremental step to get closer to where you need to be. Midday, if you're still not where you're supposed to be, based on the close on Friday and the score intraday, you take another incremental step. The reason you're taking incremental steps is during the day you're acknowledging that the market could reverse itself and rally. When we get to the close, near the close, if you're still not in line, you would take another incremental step. This 45% score here is the close on Black Monday, so the close on October 19th, 1987. So when the market closed, we would have reduced risk significantly, but we would not have gone to 100% cash. And it's also very important to note, we would have lost less than the average Joe because we would have cut risk before Black Monday and we would have cut risk during the trading session. But we would have lost money as well. We're trying to mitigate risk at the early stages of what could be a multiple year bear market. We don't know what's next at this point, so we're incrementally reducing risk and then we'll just take it day by day. As it turns out, if you went to about a 50-50 allocation at the close on Black Monday, that would have worked very well because the market didn't bottom for 46 calendar days. Between October 19th, the final closing low was on December 4th. Therefore, you have 46 calendar days of gut-wrenching trading where you're not sure if the world is going to end or if the market's going to right itself. If you're sitting around 50-50, it's very, very easy to keep an open mind about bullish outcomes because you still own stocks, or bearish outcomes because you've already taken some defensive action. One of the great benefits of going through this step by step is we're basically running a fire drill and understanding how things changed from point A to point B and how we would possibly react. And that would allow us to keep our cool during an event like this because we can basically say we've seen this before. And we have seen this before. This is very, very similar to what happened in 2011. There's really nothing new under the sun. Here's a quote about keeping your cool and how important it was on Black Monday. This is a description of Paul Tudor Jones during the session on Monday, October 19th, 1987, or Black Monday. That Monday morning was probably the greatest demonstration of trading skill that I've ever seen in my life. Even though we had this model saying Monday was the day, Paul was willing to add to his position, meaning he made intraday moves based on the hard data that he had in front of us and based on his confidence in the probabilities. There's another huge benefit to having a well-defined approach and process when you head into these dislocation events. Here's a quote from someone that lived through the 1987 crash. We were trading off those models. So therefore, Edward had a rational basis to make decisions based on facts. So even though I was surprised by the drop on Black Monday, I wasn't nearly as shocked as most. When you have a rational basis to make decisions, it's much, much easier to maintain your composure and make rational decisions rather than running around on Black Monday like a chicken with your head cut off. We hesitate to cover this event because it can get us distracted and it can get us off track. This is a very, very rare event. It's really only happened one time in our lifetime. Could it happen again? Absolutely, positively, yes. But it's not something that's going to happen frequently. We need to be prepared for it. We are prepared for it. We know how we would handle it. That doesn't mean that it would be easy or that we wouldn't lose money on this day. We would typically just lose less, maybe a lot less, because of the incremental steps that were taken in the weeks prior to Monday, October 19th, 1987. But let's put this in some context. Remember last week we talked about Jesse Livermore's take. The big money was not on the individual fluctuations. And market fractals tell us this is an individual fluctuation. It's just a large individual fluctuation. The big money was not in the individual fluctuations, but in the main movements, that is. Not reading the tape, not focusing on the short term, but sizing up the entire market and its trend. Fair question. How did the 1987 plunge impact the big picture? The answer is, if you were focusing on the big picture and the long-term trends, it had very little impact. We've covered numerous times the similarities between the present day and the early 1980s. The gain leading up to Black Monday from the lows in 1982 to the peak in August of 1987, the S&P 500 gained 229% between point A and point B. What happened after Black Monday? If you kept a cool head and had a flexible, unbiased, and open mind when you were sitting down here at roughly a 50-50 allocation, the gain from the lows in 1987 to the highs in calendar year 2000, the S&P 500 tacked on an additional 582%, and that's on top of the 229% gain that preceded the 1987 events. Moral of the story: the big money is made by sizing up the entire market and its trend. And we've covered these common missteps, and they apply to 1987 as well. This is basically a 5-year period in here. This is basically a 12-year period. If you are constantly worrying about low probability events like a 1987 or a flash crash type event, and you're constantly trying to avoid volatility, and you're always fearful of the next inevitable pullback, and you're always fearful of the next bear market, and you're always running through, if this happens, the market could do this, you're going to lose focus and keep your eye on the short term rather than sizing up the entire market and its trend. This is where the big money is made over long periods of time. Why would we take defensive action here with the model? Because at this point, we don't know what's going to happen next. It's possible that 1987 kicked off a 1929-like depression event. Therefore, it's important for us to protect capital when the odds are against us. When the odds improve, then we just redeploy the capital. These charts here show that losing some money during the 1987 crash would not have derailed you if you had properly been sizing up the entire market and its trend going into those events and if you properly sized up the entire market and its trend after those events. Focusing on low probability events has a tendency to take our focus into the short term and to take our fears into short-term time frames. It's very, very important we battle these enemies that we have within ourselves, and we continue under all circumstances to size up the entire market and its trend. And that is also true during long-term secular bear markets. There's really nothing new under the sun. You handle a downtrend, a long-term downtrend, the exact same way that you handle an uptrend. Continually ask yourself, am I properly aligned with the primary trend, which in this case is clearly down? These moves in this direction are counter-trend moves within the context of an ongoing downtrend. This is a counter-trend move, counter-trend move within the context of an ongoing downtrend. Volatility to ignore is a counter-trend rally, a positive move within the context of a downtrend during a bear market. Volatility to ignore is a pullback during a bull market within the context of an ongoing uptrend. The math works the exact same way and the logic works the exact same way. In a secular bear market, the big money would not be made in sizing up individual fluctuations, but in sizing up the entire market and its primary trend. In these cases, it's a bearish secular primary trend. We just showed what a more concerning or lower probability, or we better pay attention looks like. What does a favorable look like using these same, for illustrative purposes only, daily moving averages? This is what a sustainable trend looks like. This is the 60 all the way out to the 120-day simple moving averages on July 27th, 1995. The same daily moving averages over here on May 1st, 2013. If we zoom in October of 2017, how does the present day compare to a sustainable looking trend? The answer is very favorably. Same moving averages October 19, 2017. What does this tell us about probabilities? What happened after this point? What happened after this point, after we could see this, measure it, and put it in a model? In this case, between July 27th, 1995, and the peak in March of 2000, the S&P 500 tacked on an additional 170%. And in this case, from May 1st, 2013 to the peak in May of 2015, the S&P 500 off the charts in this case gained an additional 35%. Does that mean we're going to see similar gains from here in 2017? Absolutely, positively no, but it just speaks to probabilities, and the probabilities of good things happening, higher highs being made out here in the present day, are favorable. And the probability of something like this happening or this happening is relatively low based on the hard data that we have in hand. And the point that we always want to drive home, let's assume from this point, July 27th, 1995, we were able to maintain perfect discipline between point A and point B, which is not going to happen in the real world. And in this case, hypothetically, we were able to maintain perfect discipline between this point A and this point B when we saw an additional 35% gain. Even in a perfect world, to get from point A to point B or point A to point B, we know, this is the 1995 case here that we've been covering. Here's the point A. Here's the 170% additional gain that we just talked about into March of 2000. We know with 100% certainty, no questions asked, that within the context of an established ongoing bullish trend, there is always going to be a significant amount of gut-wrenching volatility between a point A and point B. Unfortunately, that's just the way markets work. And if we believe that our goal is to avoid volatility, it's going to be very, very difficult to capture even a substantial portion, even a fractional portion of this 170% gain from point A to point B. Similar situation in the 2013 example we just covered. This is our point A in 2013. This is our point B after the 35% gain into May of 2015. Markets are not going to make anything easy on anyone. There is an incredible amount of shorter-term volatility within the context of what is a relatively strong, longer-term trend between point A and point B. Now, before we go to the next slide, let's just take a look. Look at how much volatility there is on this chart here. Keeping that in mind, even when we have incredibly strong trends, if we are watching the market too closely, watching our P&L too closely, checking our account balances every 13 seconds, listening to every talking head on TV, worrying about what everybody else is doing, worrying about what everybody else is saying, trying to avoid every tiny little dip in the market, if we're always fearful of the next pullback, always fearful of the next bear market, always being concerned about the what if this happens, the market could do this. If we keep a short-term focus and make decisions based on short-term fear, it's going to be next to impossible to navigate from a point A to a point B that could be several years down the road, and it's going to be next to impossible to navigate from a point A to a point B that could be several years down the road. And as always, we're not forecasting here. Is it possible that the chart in 2017 over time starts to morph into something that looks like this or this? The answer is absolutely, positively yes. And that's why it's incredibly important when we wake up every day and at the end of every week, we have to collect the latest hard data, plug it into the model, and ask, are we allocated properly based on the facts that we have in hand? If the answer is yes, or we're not sure, leave it alone and give the longer term trend the benefit of the doubt. If the answer is no, and things are starting to deteriorate in a way that's outside of the bounds of the model, then we make an adjustment to get back in bounds. From that point, we make no assumption about what's going to happen next, and we repeat the process with a flexible, unbiased, and open mind. The hard data and facts that we have in front of us today say this is a low probability event. We'll continue to assess those probabilities every day and at the end of every week. As of mid-October 2017, being overly concerned and tossing and turning at night about a 2011-like plunge or 1987-like plunge in the stock market is very, very similar to being overly concerned and tossing and turning at night if you live in this area here, worrying about a major hurricane hitting these areas over the next 5 days. In both cases, the probability of bad things happening is not zero, it's never zero, but based on the facts that we have in hand, rather than fear or fear of what may happen, the probability of both events are relatively low. How do we track all of this and convert it into a usable and actionable format in a reasonable amount of time? The submodels we answer binary questions, some of them manually done, some of them programmed in Excel, and we also enter in unbiased and hard data. The submodels allow us to get a handle on the market's current profile, and the master CCM market model then looks at the current profile, compares it to past profiles, and recommends a prudent allocation between risk assets such as stocks and conservative assets such as bonds. Conservative assets can consist of cash, bonds, currencies, or any number of investment options. If you'd like to learn more about the market model or our money management services, you can visit our website, follow along on Twitter, Facebook, read our blog short takes, or watch past videos on the Shavaco Capital channel on YouTube. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.